Well, welcome back, everyone. Welcome to the first week of full trade for 2025. It's been an interesting start to the week where we've gapped up, as you can see on the SPY. Overnight action did carry us higher. We ended up operating in a range that I was speaking to members of the active trader room and folks on WealthCharts midday today about, oscillating around 597 on the SPY, roughly the 60-40-ish area, with a $3 range on the SPY above and below, 30-point range above and below that 60-40 area. And what you're seeing is a double bottom pattern that is not yet completed or engaged. Breaking the neckline does open up potentially another $10 to $13 of upside, taking us up towards the top of that regression channel again. But it's data that would have to drive it, and growth data indeed would be important. As of right now, the consensus is the market technicals still support higher, but it may require consolidation, as we have already gotten highly overbought off the lows from January the 2nd, where the second bottom got put in. Now, I had the pleasure at lunchtime today working with folks on WealthCharts to take them through very targeted methodology for looking at the S&P E-mini futures from a get your prop trading account funded standpoint. I walked folks through multi-time frame, the importance of alignment, the potential for a transition from a trend. And we were lucky enough to have one of those challenging moments in the market where we blew out all of the upside, the gas was done, and we started to get signals on the very small time frames, of course, 1-minute charts, leading to a 5-minute transition. And it triggered some shorts, and folks got to see me play around with the market very specifically and surgically, looking for that pocket of time where risks are lower, reward potential is higher, and a transition from long to short was in play. As it sits right now, the market's sitting at around 60.13. And when we just looked at the the SPY a moment ago, you can see that it's sitting at 594. Below 594, the risks grow for a continuation lower, actually. If we cannot sustain that $3 radius, it's likelier that we sustain it. We've got support in this area, but the market has gotten very, very expensive very, very quickly. You can see the selling wick on the candle on the day itself. Closing below 594 does imply a retrace back to the base, and that changes the picture. This may not end up being a double bottom. This may end up being a bounce that fails, a counter trend bounce, and a coil forming overall, waiting for the next round down. Now, the jury's out on this. Technicals do afford a bounce continuation. Closing above 597 would be instrumental to do so. Closing below 594 does increase the odds significantly for a further pullback in markets. Join me and many other amazing speakers that we've curated based on your feedback at the Wealth 365 Summit starting next week. Join us from the comfort of your home office, wherever you may be watching. Simply go to wealth365.com and register for free. Check out the speaker schedule, and the amazing curated speakers are presenting to you information that is relevant for their own trading strategies, how they're viewing the market right now, and much, much more. I look very much forward to seeing you there. And you can see that I'll be speaking actually a few times. Rob's going to be there every day. I'm looking forward to joining in with him as well and seeing you there live. Go to wealth365.com and join in for the biggest and best wealth and finance conference online on earth. Do not miss. Bye for now, all.